How do you counter that argument that we live in a high nominal growth world after we've been talking about negative earnings for months and quarters now, and we have to keep pushing out this story? What's the pushback against this?
Yeah, I'm definitely going to have to take the other side on this. So look, yes, if you look around today, things look pretty good. Consumers are clearly spending. The labour market is incredibly strong. But you just have to look at the senior loan officer survey, which came out yesterday, showing that there is a tightening of lending conditions. It's not falling off a cliff by any means. But that tightening in lending conditions will lead to job losses. There's a very, very close relationship between the two. So we are expecting things to get worse. It's not going to be an imminent recession by any means. It's not just 3 months away. We're looking a little bit further out. So it does mean that you could see the equity market stay fairly range-bound in the next couple of months if there's no other upsets. But if you're looking at over 6 to 9 month period, it certainly does look like there's going to be earnings growth really under pressure, which is inevitably going to weigh on equity markets in turn.
We've been range-bound for months now, all year, 3,800 to 4,200. That has been the well-defined tight range of the year so far. Seema, you heard what Krishna had to say there, that ultimately he believes that the pain traders' equities still go higher. Are you still married to the view that we retest the lows of late last year?
Yeah, we are. As I said, things look good right now. But if you look at any leading indicator, it's giving a fairly clear signal that there is recession down the line. So whereas last year we were talking about rates, we talked a lot about inflation, this year is really about the growth story. And that growth story will deteriorate, but we're looking at it in the second half of this year. So for now, and we could be talking about this for the next 2 or 3 months, the equities market still stay fairly range-bound. But you get into late 2023, and I think the situation will be fairly different. That's when actually the equity market can realistically start talking about rate cuts. But until then, I think the story is a little bit more of a range-bound one.